Let's continue with the sell and buy side panel where the discussion will range from selling your business to growing through acquisitions. So panelists, as I introduce you, please make your way to the stage. Alex Lawton is CEO with the Lawton Standard Company, a specialty metals platform company. Its subsidiaries include 7 sites across 5 states from which it offers a mix of capabilities to industrial consumers of engineered metal castings and related services. Alex is also co-managing director of SLK Capital LLC, a specialty finance company, as well as the managing director of LFH LLC, a diversified investment company. Welcome, Alex. Next is Vince Shiely. Vince joined Lubar & Company as a partner in January of 2011. Previously, he was an officer at Briggs & Stratton Corporation, where over 12 years he held a variety of senior operating roles, including President Yard Power Products Group, President Home Powered Products Group, and VP General Manager of Engine Products Group. Prior to that, Vince worked at Johnson Controls in the Battery Group, served as VP and GM of the Specialty Battery Division, VP of Technology, and VP of Automotive Battery Operations, and he's got more than that. So welcome, Vince. So our third panelist is Kate Westfall with Reinhart, Boerner, Van Deuren. Kate is a shareholder in Reinhart's corporate law practice and a member of the firm's mergers and acquisition and private equity teams. She represents private equity firms and strategic investors nationwide in the structuring and negotiation of mergers and acquisitions, as well as senior and mezzanine financing matters. Kate has significant experience advising angel investors and funds with respect to financings and other strategic investment matters. Please welcome Kate Westfall. And our discussion leader and moderator is Hanna. Many of you know who she is. She's the managing director and co-founder of Taureau Group. So Ann, I'll turn it over to you.
Okay. Well, good afternoon, and thank you all for being here today. I think it's really terrific, a really fantastic story from an iconic Milwaukee family and a successful startup, showing us how it's done from both ends of the company life cycle. So thank you for being here and sharing your story with us. So I'm Hanna, Managing Director and co-founder at Taureau Group. And I've been buying Funky Fresh spring rolls for at least 6 or 7 years now. I love them. You got to get the sauce that goes with them. Really good. So today we have a panel, and the panel is designed to help you navigate the road ahead. They really have a terrific background on both the acquisition front and as sellers of businesses. And I'm going to ask them to give us a little more. We heard their story as far as their background, but I'm going to ask them to give us a little more background on exactly companies they've sold, when they sold, the industries they were in, and also companies that they purchased, because they all have a tremendous amount of experience and advice to share. So why don't we start with you, Kate? Just give us a little more detailed M&A background.
Absolutely. So happy to be here. I'm Kate Westfall. I am a shareholder at Reinhart. I have been doing M&A, sell side, buy side, for over a decade. We represent startups. We represent VCs, funds, angel investors. So no particular companies that I've bought or sold, but we've certainly represented over 100 or so.
I'm Vince Shiely. I'm with Lubar & Company. June 6th, I've been working in industry here in Milwaukee for 40 years. I've been part of the largest companies in the Milwaukee area. Did quite a bit of M&A in them. The biggest one there was I was with Briggs & Stratton when we bought Generac Portable Products from the Kern family. But 12 years ago, I joined Shell and David Lubar and Lubar & Co. And in the past dozen years, we've done a lot of deals, from buying a chemical company to Erdman. We bought it back. I'm not supposed to say this, but we bought a bank. But I'm not supposed to mention that name because there's another bank that's sponsoring the event here. But Shell Lubar said in his late years he wanted to own a bank, so we went and got one of those too. You should get one too.
Absolutely. Collect them. I'm Alex Lawton. My primary job is running a casting-based metals company, manufacturer and services. have a kind of a boutique finance company that friend and I started back in the Great Recession when there seemingly wasn't enough finance going on. Just if, you know, in life, I got kids that are great athletes. I'm married to a wife who's a great athlete and competitor. And, you know, as it grew up, it's like this becomes the field of play for competition, right? As business. And you met wrenching relationships over and over, right? You form so many relationships, and it's a great way to, you know, do well while doing good while feeding those, and just love business, the game of business, and, you know, trying to help others with it yourself and so on.
Great. So you do have already. Finance company anyway.
Yes.
Right? So let's talk about sell side first. And, you know, Drew told us when he was up here that you should have the end in mind when you go into business. So as far as having a company and knowing when to sell, we've had all these factors. So we've had commodity pricing, and we've had interest rates, and we've had a lot of demand factors. Alex, how did you make the decision to sell? How do you know it's the right time to sell?
Okay, so back in 2018-19, was kind of getting to a personal and company inflection point. It was a family-owned manufacturing company. 1836 was its founding. I had been shepherding it for quite a while by then, and I either wanted to go into growth mode of a totally different variety and risk profile, or I wanted to do something else. So rounded up the rest of our shareholder stakeholders, and decided that doing a transaction was the right thing to do. Spent probably a year or two, in some ways many years with little things, but then a year or two kind of formally building up for and getting ready for that, and going to find the right partner where we could do some retiring of folks from our group and de-risking and other things, and yet get the company ready to go on what I saw in the marketplace was a nice track for growth. We just weren't the right group at that time to go capitalize on it, so we had to change that.
Great. Vince, anything to add to that?
Well, so I'd start with the fact that if you're going to sell your business, you better have a great business. So what makes a great business? And it's three things. It's having a great management team, having a great management team, and having a great management team. And if you don't have that, there's no sense in going to the marketplace. Number two, you need a defensible position. You got to have something you're doing that's interesting. You got to have something that's different from everybody else. And third, you have to have a management team with a strategy active to take advantage of whatever that possibility is. And if you have those three things and your management team of your business can represent that to others, you can write the ticket to sell your business. If you're missing that, there's no sense in doing it, no matter what you heard sitting in the bench at the golf club next to your friend who just sold their company for 15 times EBITDA, because it's not going to happen.
So is that the preparation process that you go through?
Well, and preparation isn't like, well, hey, I think I might do this in 6 months. Preparation might be a decade, might be years. It takes years to implement strategy. It takes years to put a perfect management team together. It takes years to get it right. And our problem at Lubar & Co. is we do that, and then we don't want to sell it. Because when you have a great asset, the owner turns around and goes, well, now why would I sell this? That's one of the reasons that everybody thought the baby boomers today would be selling all the businesses they built in their life. But they've all turned around and said, I've got this amazing business that I've built. I've got this amazing team. I'm doing what I love. Why would I sell it? We've come very close on several large transactions. There was one time we were negotiating with a European company. They were going to pay us a stupid amount of money for one of the businesses that we own. David Lubar and I were on the phone, and the person on the other end of the phone started talking a little wacky and was trying to save $5 million here or there. And David and I looked at each other and go, and this was going to be a $100 million check. And we say, well, we're going to sell this business for $100 million. We're going to pay the government 40 million of that. We're going to net 60 million, and then we're going to have to go out and pay 10 times EBITDA for a business in a new industry with a management team we've never met before and try and do this all over again. And you know where that ended up. We still own that business.
Well, if you think management team is so important, what do you look for? Are there certain characteristics?
Well, is Ron Miller in the room? Ron kind of knows my style. If we get shown a business, Dave Bauer and I and David Lubar, the first thing I want to do, first of all, the investment banker tries to keep you from talking to them. Okay, which is foolish because that's what I'm buying. I don't want to see the equipment. I want to talk to the management team. But investment bankers are designed to keep you from talking to the people you're selling with. You get them on the phone, and all I have to do is hear a CEO talk about his or her business for 5 minutes, and I can tell you that they are or are not the right partner. You're looking for somebody who's got a vision, energy, understands the business implicitly, knows their people, so on and so forth, and they give that away in about 5 minutes. And that's all that's what it takes.
Yeah, and I thought Giacomo's comment earlier was a good one, which was your advice is never to just pass off the legal docs, right? Because people are going to go to the business owners, they're going to go to the management team, and they want to make sure that they know what they're talking about. We especially see this a lot in the fundraising world. You know, you have a lot of founders, maybe they have an engineering or a SaaS background. They have to understand valuation. Those are the ones who are interfacing with the investors, and the same is true in the sale context. Even if you are the strategic inventor, you have to understand the ins and outs of your financials, and your team does as well, otherwise you might lose out on deals.
Well, Kate, expand on that. What else do you need to do from a legal perspective to get ready?
Sure. Well, I think there's 3 things from a legal standpoint. You know, you heard that the deals started from the founder earlier. The deal started in January, it ended in December. So I think the first thing I would recommend is that you get your team in place. This is your internal team and your external team. Your external team are your accountants, your M&A attorneys, maybe even your estate planning attorney if you expect, you know, to be a recipient of funds. And then you've got your internal team, which is which of your executives are going to be brought under the tent from day one. There's a lot of things that you can do over the course of a year to make sure that your business is more attractive. Maybe it's putting in sales, you know, change of control bonuses for your executives. Maybe it's just a lease where you're making sure that you can assign it without having to go back to the landlord. Maybe it's not buying a piece of capital equipment because the buyer is going to treat it like debt. Maybe it's negotiating a longer contract if you have some sort of customer concentration. You know, there's a whole bunch of things that you can do to make your business, you know, sale ready, and that stuff takes a long time. So don't get me wrong, the meter doesn't start for these terrible attorneys, right? But bring them under the tent, you know, have lunch with them, let them know that you're thinking about an exit, because there's a lot of things that they can do to help you. I think the other thing, you just have to spend time figuring out what the value of your business is. This isn't just the financials, but also who would be a buyer. Is it strategic? Is it PE? Because that's going to ultimately dictate the multiples. And sometimes, depending on who your buyer is, the multiple might be 2 or 3x smaller than you anticipated. So I think this is where Ann and her team come in, but the investment bankers they just paid huge dividends. You know, at some point in the process, we heard about it earlier, sellers get deal fatigue. I mean, it is just exhausting, the number of requests that you have to take, and it's like you're wearing 2 different hats. So I think, you know, we have Lamar Jackson out here now, right? Trying to negotiate his contract isn't getting anywhere. Let your advisors interface with the buyers. Let them be the ones being the bad guy, and I think you'll have more success. And then I think just the very, very end is know what matters to you. A lot of times you just make the assumption that it's purchase price. We've been doing this a long time. It's not just purchase price. Every deal is completely different. I had a deal a couple years ago where the seller, it was his 3rd exit, But he left $3 million on the table just to make sure that his employees were going to be treated well on the back end. It meant staying in Milwaukee. It meant putting in place a bonus agreement. It meant putting in place a management incentive plan. Just things like that that were crucial to this particular seller that to somebody else might have not mattered at all. For others, it might be, do they want to roll over money? Maybe you do, maybe you don't. Do you want to be around for 5 years or do you want to be around for 2 years? So I think spending time to think about what's important to you, think about what's important with your family, discuss it with advisors, but whatever your goal is should be the goal that your advisors are trying to implement. It shouldn't always be the highest price. It should be whatever is important to you, but your advisors won't know that if you haven't thought about it.
Great advice. So Kate talked about buyer types, and Alex, maybe you could talk to us about the different buyers you looked at, where you ended up, and I know you continue to work for that buyer today. Give us a little bit of that background, and just let me remind the audience, if you have questions, the number's on the screen.
Yeah, we think about it, or I thought about it anyway in personas, and Corey and I talked a lot about it. Leading up to it as you were going through, right? There were a handful, and then they kind of repeated within categories, but personas that would be likely in what I'd call qualified. They'd have the wherewithal to do right by the company and let it go. So we ended up finding, and this could only come from going through a process or totally organically. We ended up finding a group that had a like business. It was somewhat of an orphan asset of theirs as an investment group. So we formed a new company, contributed ours, recapped out, right? We stayed, I think we're the largest owner, but it's no longer our company in particular. And then I got tabbed to, back to the growth agenda for the industry, I got tabbed to then build that new company into what we wanted it to be 5 to 7 years out. So in that case, that was a theoretical situation, but then we found the actual one. And as we were going through the process, it wasn't necessarily the most lucrative, but when I thought about how are we going to get our stakeholders, especially employees, others that were close to the company, comfortable with this, how am I going to get family members for a business that we've owned for well over 100 years comfortable with this, it became pretty apparent that if I were willing and able, right, and going to get to go check those boxes of saying, hey, I can go on the offensive in this industry, this is actually probably the best way to do it, both personally from a challenge standpoint and for those other stakeholders. How do I get them comfortable with the transaction? So we looked at classic PE, we looked at strategics, we looked at this scenario and a couple of others, and settled on this, and I think, so far so good in terms of most of the alignments have been good.
So what is it like to work for that buyer now, years later?
Most of the time I enjoy it. When I'm stuck doing the sponsor's work, I get a little frustrated. It should be their job, and probably when they're making me do management's work, they do. It's been 80-90% as advertised, I think, on both sides. To your point about a management team and to yours, what they bought was our track record and our management team. And they're like, we want that, right, on a grander scale. And that's what finally led them to be thinking about, say, valuation and multiples and everything. And one thing to move to another is like, please take that and build it and cross-pollinate it and whatnot. So frankly, it's been, for all the anxiety I'd have about it, and people plant seeds in your ear and you hear about those kinds of deals and transactions and they never last. So far it's been really pretty good. And we tried to vet that a lot up front, but you never really know probably till you get into it. But
Terrific. Arthur, do we have questions from the audience?
Yes. Got a few. We'll start with, on the buy side, how do you determine the best way to pay for the acquisition? Your own cash, investors' cash, bank debt, seller debt, other?
Was everyone able to hear that? I'm not sure. Yes? Okay.
He said, how should you How are people capitalizing deals today? Bank debt, equity, other kinds of debt.
Yeah, since we did our deal in December of 19, which the timing was interesting for a relatively levered deal. I'd say having a sponsor in the mix has made it different from a family-owned business, in that, you know, can we do it without more capital, right? You got to run through those all the time. And we've bought, I think, 6 businesses since, in addition to what we're trying to do organically and whatnot in the CapEx. And I would say, they're going to fix us with the lease rules, right? I'd say there's been an element of financial engineering. Our senior has been great. Bank that we switched to in the middle, and then we've rounded up equity or other junior as needed, and we just keep repositioning the portfolio. In some cases, the seller is really interested in us, because they like the way we treat folks in our industry. They like what we're trying to do with the company and what they think it means for theirs, and they end up being supportive, either via financing or other deal terms, to make that happen. So it's been no one size fits all at all, and you try and stay with the principles of what are we trying to get accomplished for that entity and their stakeholders and ours, and then we'll construct the deal around that.
Great. Vince, did you want to comment?
I'd only add that the greatest disservice you could do to a management team is leverage them up. Over the past 5-7 years, money's been all but free. 3.25% interest. We were all, itchy when we saw 3.75% on a bank term sheet. That's gone. And I feel sorry for management teams that are coming up on their 3-year renewal, 5-year renewal. That loan's going to renew at 6.25%. And let's say they threw 4 or 5 times leverage on the business. And especially if the business hasn't performed, now you have 5, 6, 7 times leverage. And you have a management team that's now not trying to figure out how to run the business. They're trying to figure out how to make an interest payment to the bank to keep things from being difficult. So my recommendation, and what we do at Lubar & Co., is we make sure the management team doesn't have to sit and worry about making an interest payment, because that is a huge distraction to them. But unfortunately, that's what a lot of private equity firms will do in order to keep the equity investment down.
Well, and the banking environment has really been a hot topic right now as we're going through M&A deals. Kevin, could you just tell us a little bit about what's going on in the bank?
Thanks, Ann. And the point that Vince just made, it truly is critical. Any good banker does not want to see their clients overextended, overlevered, either from a senior or a total debt basis. Obviously, the operating environment, given the actions of the Fed to increase interest rates, to battle inflation in such a condensed period of time, has been difficult. And what I would tell any borrower is to measure twice, cut once, in terms of any actions around future indebtedness. If you have debt maturing, coming up for maturity, reach out to your bank, reach out to your bankers, get more than one opinion, and think long and hard about how much leverage you wish to put on your business in this current operating environment. Thanks, Ann.
Great, thank you. So we switched over to the acquisition side, talking about buying businesses. And in times of uncertainty and market volatility, M&A tends to slow down. But it's also a time, although it hasn't slowed down yet, but these kind of times, if the recession that is being predicted and has been predicted for a year ever comes, is sometimes a great time to be a buyer. It's the time at which you can find opportunities, and some of your best acquisitions are made during a downturn. So to that respect, Vince, do you think, are we in the midst of shifting? Are we going to go from a seller's market that it's been for the last 8 years to a buyer's market?
Well, now you're asking a question that you gave us in advance. I was prepared for this one.
Shoot.
It's really interesting. We were out on a walk. Our group in our office takes an hour walk today, every day that we can together. We leave around 11:30 if you want to meet us around the lagoon near Summerfest. Anyway, September to December of this year, the number of deals coming into our office was incredible. It was like a fire hose. It was like everything was for sale. And it became the oddest mix of businesses: electrical contractors, construction businesses, service businesses, distributors, so on and so forth. There were so many. We like to reply to every deal. Mitch Rezkowski in our office, we go back, here's why we like the deal. We want investment bankers to know what we're looking for because they've just sent us something we don't want. They were so many coming in, we couldn't respond. January 1, it stopped. The email stopped. The deal flow has stopped. Probably in the last several months, we've seen like 3 or 4 emails. And I've talked to other folks, and actually, frankly, that's going on in the industry, and they're saying the faucet's gonna go back on June 1. And I don't know what's special about June 1. I'm going to predict another fundamental problem going forward. With the performance of the stock market and the performance of the bond market, which actually almost brought a bank down, did bring a bank down, brought 2 banks down, and that's not over. If you think about people like Kelpers, NML, so on and so forth, they are now over-allocated on private equity, because they don't have to write their private equity down to the value of it as immediately as stocks and bonds are written down. So now all of a sudden, all those people have more private equity than they wanted. They usually want 8 to 11%. Well, what that would suggest is there's going to be a reduced flow of money into private equity and a reduced number of deals. And I don't know what the net of that is going to be, but just watch. It's not crazy town like it was before. I will suggest the idea of the 10, 11, 12 times EBITDA deal, I think those are gone. In fact, the only company that I think can probably go sell their business for 12, 13, 14 times EBITDA is you guys. The last high multiple section left in private equity is a food brand, because food manufacturers will pay out of their minds to get access to a great idea like you have. But other than that, you better have something really special. So I think we're in for some interesting changes, and I don't know where it's going to end up. I will tell you, one of the questions you said you were going to ask is it hard to find a good deal? And the answer was it's impossible to find a really good deal. And my answer to you, Ann, was going to be, I thought about this all night, so I have to tell you the answer from the question you didn't ask me. It is really easy to do a bad deal. You can do a bad deal faster than the speed of light. If you tell the lawyers, I want this done in 30 days, they will do it in 30 days. Banks will get you term sheets. You will get this all done, and then after you've paid 10 to 12 times EBITDA and you have your closing dinner, you're going to have what's called the vomit moment. The vomit moment happens when you go, what have I done? It's the same feeling you and your spouse have when you bring your new baby home. And you say, what have we done? And what do we do with it? There's no directions. It's like an iPhone. How do we make it stop its notifications? And we've seen that can I give one example? We got a few minutes here.
You're a politician. You're going to say what you want, right?
3 years ago, we saw a deal we absolutely loved. We had been courted by the company that was selling it for 10 years. They told us we were the buyer. But they weren't ready to sell. They weren't ready to sell. Time went on and on and on and on, and all of a sudden we get a book from an investment banker. It's our business. We know the management team. We love the management team. We love the management team. We love the management team. Okay, it already surpasses all. It's 10 million in EBITDA. And we give a really nice offer on the business. In 48 hours, we're told we're 30% low. It's our perfect deal. And that is the moment at which you have to say, we are not going to do this deal. It was going to cost us an extra $40 million to do that deal. Fast forward, 4 months later, we're aware that that company lost one of its largest customers. EBITDA went from 10 to 6. I imagine an investment banker would tell me the multiple is no longer 10 on a business that just went from 10 to 6. That buyer saw $60 million worth of value evaporate in 6 months. So I'm telling you, you have to be really, really careful about that. That was the best. Somebody says that was the best deal we never did. My point was, you got to be ready to say no, as you know, Ann.
And that's the vomit moment for the investment banker when that happens.
You know, you brought up something else interesting, and it's something I thought I knew, and I learned it this past year. If you think you're going to do a deal, do not tell your people. Give it a chance to grow. Give it a chance to find out if it's really going to happen. Nothing distracts a management team worse than you telling them they might be sold immediately. Who's going to be my boss? Am I going to have a career? Their whole life turns upside down, and you don't need that, especially if the deal doesn't happen and you've just screwed up everybody's thinking and everybody's focus because you wanted to be inclusive. And I had one of our CEOs tell me, I want to tell my people. I go, you're not going to tell them. And afterwards, we didn't do the deal. And he goes, thanks for doing that. So when you were talking about that, maybe you've seen that.
Yeah, we talk about this quite a bit with our clients, because the question is, what's the timing? When do we tell them? Who do we tell? Do we ever tell them, or do we just let them find out at the kind of the release, if you will? But it's really dependent on the business, incredibly, person to person. Everybody knows their personnel better than we do, but generally speaking, we actually advise clients on the front end to take measures to protect the deal. So it might be tell no one. It might be tell one person, but that person's, not in HR, not in IT, so it's not somebody who absolutely is deal critical. Most likely it's the CFO or the CEO, because no one's really going to walk down the aisle even a little bit unless those guys are involved. But then it's all about the confidentiality. I mean, we've gone as far as having folks sign confidentiality agreements on the management team, because they need to realize the impact of if this deal gets out, it's catastrophic in some cases.
I think that weighs into the exhaustion too that was talked about earlier. The docs, you guys create such volumes of documentation, right, and all the stages and whatnot with a deal. While you're doing that, and you're on the management team, whether you're trying to buy or sell, somebody's got to be running the business every day, right? And Corey and his team are in your inbox 100 times a day, and it's like, that's great. I've got customers to deal with and employees to deal with and everything else, because the business has to keep going. I think that's part of what weighs into the exhaustion with deals. Not only is it fish out of water, we're working on something, I want to solve a customer problem, an employee problem. And ideally, the transaction is part of some solving problem, but I think that's really what weighs in. And so if you've got a company culture and a management team in particular that's all messed up because they're worried about the deal, and everybody's working on the deal who's working on the business, it's a huge risk.
Right. And we're getting short on time, so I want to ask one wrap-up question for each panelist, and that's, with 20/20 hindsight going into a transaction, whether it's a buy or a sell, what advice would you give? Alex, we'll start with you.
20 hindsight going into a transaction. I would say, she put it really well earlier when it was, outline your goals, right? What are your objectives for the transaction? Listen to your advisor about whether you're maybe even off on some of those, because they see a lot more deal flow and they don't have the forest through the trees problem yet of your business and your deal and whatnot. But reground in that regularly as you go through it and after, because they take on a life of their own. So it's so easy to have it morph and drift and everything else, but you did this for a reason. You're trying to sell something, you're trying to buy something for a big reason. And trying to ground in that is, I think, a really important thing, and let your advisors help you do that. Like you said, that they'll hit a timeline, sometimes to your detriment. If you push them hard enough, the good ones won't. They'll balk and walk, but most won't. So there's push and shove and everything there. You got to listen to them. But I think that remembering at core, it's kind of a squishy answer, but there's a reason you did this. And are you still holding on to that, or did you just drift? How much scope drift or intent drift did you have?
No, great advice and a recurring theme, I think, here today. Vince, what's your 2020?
I'd say after you close a deal, be ready to adapt. The thing I can assure you is that spreadsheet that represented the pro forma, that business on the day of closing, is going to look nothing like how that business performs over the next 10 years. Almost every one of Lubar's 10 businesses in the past 10 years has had to go through some major transformation and strategic redevelopment due to changes in the marketplace. And so that's why I say, as long as you have a great management team who can help you adapt, just be ready that it's not going to work the way that you modeled it out.
I'd second that. That's really well put.
And I think, my last piece of advice would be, you might be framing your advisors as individuals in different silos, but I think really you're better off and you have a more efficient product if you actually view them as a team. So I think bringing them together early so that they are working directly. So our most efficient deals is when we are working directly with the accountants, directly with the investment bankers, and everybody's just on the same page. And obviously the client is involved in all of that, but we're not driving everything through the client who's then driving it to their accountant. So just think about the team in general that you have of advisors and allowing them to shine and work together.
Great advice. And there's a lot of questions that we didn't get asked. And Arthur, I know we have got a lot of questions from the audience, but we're just about out of time now. So if you do have questions, please find out our panelists. They'll be around, or find someone from Taureau Group or other advisors that are in the room. And we'll try to get all of your questions answered. Thank you. Thank you for being here.